Welcome to The Explainer. Today, we're diving into a fascinating and honestly a pretty ruthless post-mortem of an AI trading bot. Just last week, this exact bot looked like an absolute sure thing. I mean, it had the data, it had all this momentum, and it really seemed like it had totally cracked the code of prediction markets. But, well, as we're about to see, the market has this funny way of humbling even the absolute best, most sophisticated algorithms. This bot met a sudden, spectacular, and highly educational demise. So let's just jump right into this autopsy and figure out exactly what went wrong.
Okay, I want to start with the ultimate hook here. Across this massive fleet of 25 parallel AI strategy experiments, all trading on short-duration binary markets, the empirical win rate was a staggering 78.3%. Just pause and think about that for a second. If you saw some retail trading guru online promising a strategy that wins nearly 8 out of 10 times, it sounds like an absolute goldmine, right? It literally sounds like you've unlocked an infinite wealth glitch.
But here's the brutal reality of the situation. Despite that massive, near 80% win rate across the board, the Freet's aggregate simulated profit and loss is a stark negative $2,500. And that's on a $7,500 deployed paper bankroll. They literally lost a third of their simulated bankroll. The money? It's just gone. Which naturally brings us to the central mystery of our explainer today. How exactly do you win 4 out of every 5 trades you make and still end up completely draining your bankroll? It feels so counterintuitive, doesn't it? Like, mathematically, it just feels wrong. But actually, this is the ultimate trap of prediction market trading. And by unpacking this exact trap, we're going to learn a completely crucial lesson about how these markets actually function behind the curtain. So to solve this mystery, we've got to introduce our primary victim. Out of 21 initial experiments, there was exactly one strategy that showed the statistical signature of a real, genuine edge in week 1. It was dubbed the Bitcoin Fair Value Taker. Now, it had a slightly lower win rate, but it had these asymmetric payoffs that were large enough to supposedly overcome its losses. It was literally the only candidate worth watching, the shining star of the entire fleet. And man, this brilliantly illustrates just how fast things can fall apart. The timeline of this collapse is just brutal. Check this out. At the end of week 1, the BTC fair value strategy was up roughly $800 on a $300 paper bankroll. It was absolutely flying high. Then, in a single overnight session, it lost roughly $850. Poof. And today, it is sitting at exactly $1.84 in equity. The total realized P&L on that one experiment is now negative $298 across about 750 settled trades. So this wasn't just a tiny dip, it was a total unforgiving wipeout. And the crazy part is, it wasn't just our star player that went down. This crash infected the broader fleet too. They had this backup hypothesis, a dedicated BTC maker strategy that was specifically designed to avoid fee taxes and adverse selection, and it was also thoroughly crushed. It finished the week with just 49 cents in equity and a super dismal 22% win rate. Basically, informed market flow completely ran over it. And, as we saw earlier, the overall fleet is down 33%. So the star candidate is dead, the backup is dead, and the whole fleet is bleeding out. Now, when a previously promising signal just vanishes, human nature, and especially trader psychology, we all just want to call it a fluke, right? We say, oh, the market just punished my edge temporarily. But Thorsten AI, the researcher behind this entire experiment, uses his own blunt words to dismantle that comforting myth. He states that the baseline assumption is no longer that the strategy is good. No, the assumption now is that it was simply lucky for the first 250 trades, and reality has finally caught up. It's essentially mean reversion in action. And we can see exactly how that luck ran out when we look at the sample sizes. During the first 250 settled trades, the strategy looked like it had a rock-solid edge. But over the next 500 settles, the actual mathematical shape of the trades completely changed. The win rate actually stayed pretty similar, but the average payout for a win shrank, and the average penalty for a loss grew. This wasn't just random noise. Hundreds of new trades proved that the underlying model was just fundamentally wrong about which side of the market it should take. This brings us to a really crucial concept, and honestly, a core lesson for all of us today, the vanity metric. So, what is it? A vanity metric is a statistic, like that massive 78.3% win rate we talked about earlier, that looks incredibly impressive on paper, but is practically meaningless without context. In trading, you literally cannot look at a win rate without knowing the implied probability of the entry price. Without that context, a high win rate is just a dangerous illusion. It's the exact trick used by retail trading gurus to sell expensive courses. Okay, let's break down the math clearly because this is the crucial point. If your strategy wins 95% of the time, but you're paying 95 cents for those entries, you barely break even before fees. But what if you win 90% of the time on 95-cent entries? You are actively losing money because in that scenario, the one single massive loss you take completely wipes out the tiny little profits from your 9 wins combined. You can win 4 out of 5 times all day long, but if your one loss is huge, your bankroll goes straight to zero. And our autopsy uncovered another fatal error too, assuming things generalize. See, different markets are absolutely not the same market. This bot strategy was calibrated heavily on Bitcoin, but when they tried to apply that exact same logic to Solana, Ethereum, and XRP, it failed catastrophically. Every single underlying asset has its own volatility, its own dominant participants, its own unique microstructure. So calibrating on one asset and just assuming it works everywhere, that is easily one of the cheapest, most common mistakes in algorithmic trading. Now, in the spirit of total transparency here, there are actually 5 experiments out of the original 25 that are technically net positive right now. So you might be thinking, aha, there it is, there's the edge. But hold on, because Thorsten immediately pivots to explain exactly why we absolutely should not trust these so-called survivors. Let's dissect them step by step. First off, 3 of these survivors are basically the exact same idea, trading the exact same underlying asset, Ethereum. So it's basically one bet, voting 3 times, not 3 independent confirmations. Next, another bot is up just a few dollars, which falls totally within the margin of random variance. Plus, its sibling strategy just completely collapsed. And finally, the last one is just flat. It's making no real money at all. The underlying math says these shouldn't be positive, so they're surviving right now entirely on temporary luck. And honestly, this is where the discipline of a real researcher truly shines. Because the temptation right now would be to engage in curve fitting. If you're not familiar, curve fitting is this dangerous temptation where you look at your failed models and you endlessly tweak the parameters on your past data just to find a configuration that would have made money historically. It creates this perfect, beautiful illusion of success in a backtest, but it completely destroys the integrity of the real experiment. It is a trap that has wrecked countless retail traders. Because of that danger, the researcher laid out some very strict constraints for what happens next. First, they are not doubling down in curve fitting. Second, they are not turning the live real money switch on. I mean, the whole point of paper trading is to prove it works before risking real capital. And the data right now clearly screams, not yet. And lastly, they are not pretending that 3 highly correlated bets on Ethereum magically equal a diversified, safe portfolio. Instead, they're taking actual scientific next steps to learn from this $2,500 simulated loss. First, they're running long-horizon replays of recorded market data to safely test parameter combinations without burning through fresh paper bankrolls. Then, they're building better calibration views to check the model's honesty. Like, if the model claims it's 75% confident, does it actually win 75% of the time? Finally, they are cutting down all the noise to focus on a much smaller, hyper-focused fleet of marginal candidates, and even including deliberate mathematical losers to serve as controls. You know, this entire explainer really hinges on combating one of the biggest problems in the trading world, survivorship bias. We usually only ever hear the unblinded success stories, right? Someone backtests a strategy, it works out perfectly, they share it, or let's be real, they usually try to sell it to you. But we never hear a peep from the massive graveyard of people whose strategies completely failed. But these negative results, like this bot's total wipeout, are just as incredibly valuable as the positive ones. Which leads us perfectly to this incredibly powerful quote from the author of the experiment. The point isn't to find a money-printing strategy. The point is to put real, honest research into the public record so the next person doesn't have to repeat the same uninformed optimism. That hits the nail on the head, doesn't it? This is exactly why publishing a total outright failure is actually a noble goal. It literally saves the next person from stepping on the exact same landmine. Okay, before we wrap things up, let's rapidly fire off the hard truth that this AI bot experiment laid entirely bare for us. 1. Prediction markets are structurally hostile to part-time retail strategies, period. After fees, it's basically a zero-sum game utterly dominated by sophisticated professionals with institutional-level speed. And 2, remember, this bot traded simulated money. Real markets are fundamentally worse than simulations because you're dealing with slippage, latency, and fill failures. The overwhelming majority of participants lose money. So, I want to leave you with this final, provocative thought. This experiment was run by a highly sophisticated AI researcher, And even their absolute best candidate collapsed under the weight of 750 simulated trades. So, if the guaranteed strategies that these retail gurus market you online can't even survive a paper simulation, what do you think they are actually going to do to your hard-earned real-world money? Thanks so much for joining me on this explainer today. Stay skeptical, stay curious, and keep learning.